Good afternoon. This is David Ruffin, principal of Intellacredit. I'm going to start the presentation in about a minute or so. There's still some attendees signing on, and we'll get started in just a bit. Again, good afternoon and welcome to today's webinar, Loan Review Best Practice Trends. I'm David Ruffin, principal of Intellacredit. A couple of housekeeping points. There will be 3 polling questions embedded in the presentation today. We enjoy your participation in that. And relative to your participation, David Littleton, our manager for Intellacredit, will be monitoring the chat. So if you have any questions, please feel free to send them to us. Again, my name is David Ruffin. Hopefully, as part of some validation, I've listed some of the experience I've had in loan review work and working with financial institutions, primarily community financial institutions, over the many years. So hopefully I have a little bit of standing in terms of what the so-called best practices may be. One of the things that we're so proud of at Intellacredit, we're the newest division of the QwickRate family of products and services for community financial institutions. What's so important with that, I think, is that we're all about providing kind of big bank or big institution products and services at community financial institution practicality and affordability. That's really a tradition that we feel very strongly to adhere to. The loan review, from our perspective, that is really arguably involved since 1990. I've been involved with loan review work since 1990, when really the federal regulators mandated that independent loan review of commercial purpose loans be instituted within financial institutions. I feel like we have understood what approaches work and what don't. We'll share a little bit of that in the presentation today. I've been certainly in the production, and our reviewers have been in the production and risk firing lines. Credit is not academic to us. It's not just a matter of accounting terminology to us by any means, because we have been involved as credit officers, as lenders, and so forth. We do understand the distinction between quantitative analysis and qualitative. I tend to believe that credit, generally speaking, is kind of like a large pyramid of quantitative calculations capped off by qualitative decisions. We certainly have a symbiotic relationship with regulators. We understand fully what they're looking for. And however, we do understand too that it is very, very important that you be kind of captain of your own ship relative to writing your own script of risk. And we think loan review is a key part of that, because whether or not you're doing it in-house or vendoring that out to a third party, that's part of your risk management strategy and should be seen in that regard. I'm a big believer that effective loan review has really one primary power, and that is of persuasion. If you know and believe anything around the credit dynamic, I think it's about the need to be able to challenge assumptions in an informed and respectful way. And I think that's certainly one of our cultural instincts at Intellacredit. We also think that it is a business model, arguably, that hasn't changed in decades, other than perhaps word processing and spreadsheet technology. Particularly third-party loan review is a model that has not changed in decades. And we'd like to talk a little bit about how you might begin to look at alternative approaches to that against that more staid and frankly stale model. So polling question number 1, would like your participation in it, is do you see loan review as an audit or an advisory service? So let me, hopefully this is, let me relaunch this poll. So you have a few seconds there to hopefully to indicate your preference on that. All right, we'll end the poll and I'll gladly share the results. So basically we got a bit of a split, but it's a 60-40 that it's an advisory service. So I do tend to agree with the majority on this, that sometimes people think of it as an audit, but from the pure accounting technology or definition of loan review, it does fall under advisory service. And I think that's a positive because again, from a purely accounting perspective, I think it needs to be looked at as consultative and advisory as opposed to an audit. But again, I know preference, and a lot of times people use the generic term of audit in a more general way. So there are a lot of credit uncertainties in the COVID and post-COVID environment. 2020 was really a high performance year, far beyond what anybody thought would happen in the spring of 2020. The Armageddon that everyone feared that was going to be ushered in by COVID just hasn't materialized, and certainly credit metrics at 10,000 feet imply virtually nothing onerous has incurred. But there's a lot of temptations to claim victory. We're just that good at managing things through financial industries. We've certainly got a lot more capital cushion than we did 12 years ago at the last financial crisis. And yes, there's one other huge benefit, I think, to the financial industry is no one can point a finger of blame to financial industry or financial banks or credit unions for that matter, as far as the blame game that went on a decade or so ago. But as the former and deceased now commentator Paul Harvey used to say, as he would pivot to the rest of his story, we have to accept the fact that the financial industry has indeed been also the beneficiary of this massive government largesse through the PPP loan program and also the regulatory relief that was granted the financial industry largely through 2020. But those have subsided or abated now. There is still, I think, a very real issue of within our clients and our prospects who reside on Main Street, not Wall Street, as to who is surviving, who will be affected perhaps permanently by the COVID effect. There is a bit of taint in traditional debt going on, and I say this to not be casual about it, but I do think there's a psychology in the marketplace that banks have to, or financial institutions have to realize that if you've been borrowing money from a customer standpoint for 12 months, not having to repay it, then you've got to get back into a different psychology of having to repay debt. And that honestly is, I think, effectively going on out there. The other huge news that we're all dealing with is our industry is largely in negative loan growth. So where is that coming from? This graph comes from our sister division, Quick Analytics, and it talks about commercial banking, less than $10 billion in assets. Again, that's really where our bailiwick is in the community financial space. As you can see, a big drop off in average 12 months organic loan growth. Frankly, there's only among commercial banks, only loan growth showing of any pulse at all is the banks above 500 million. 50% of the banks, roughly 52% of the banks under $10 billion actually have had no loan growth, no or negative loan growth since in the last 12 months. That is a significant issue, particularly given the fact that we're dealing with such compressed NIMs already. And everyone knows here that making good loans, profitable loans, is the heart and soul of the profitability of the financial industry. You can't make that up in investing in securities at this point. So credit uncertainties are afoot everywhere. I think a lot of people still thinking about trying to convert PPP loans, which frankly was a huge boon in terms of reputational enhancements to community financial institutions due to the participation level of community financial institutions in that area, but trying to convert that to a stable organic loan pool, I think, is important. Certainly embracing more and more institutions of embracing government guaranteed loan programs for growth. No question about that. And that makes perfect sense in terms of growth and fees, and also, frankly, the credit mitigant that type of program may afford you. I would argue we're in perhaps the greatest churn economically since the internet, and it's been exacerbated, of course, by COVID quite a bit. And whether it's looking at the big box or the e-commerce effect on potential customers, COVID perhaps has permanently changed the paradigm on office space. There are certain markets where there is really a out of kilter supply and demand aspect, particularly in 1 to 4 family housing inventory, which is exactly the opposite of what was going on a dozen years ago. And many lenders are on the sidelines, frankly, because of the fear of being tagged by a regulator for being too involved in speculative lending. No one's adhering or urging us to go back to some of the sins of a dozen years ago. But my point there is, in some cases, we're really not stepping up to lend legitimately to right this supply and demand imbalance that exists in certain dynamic markets. I'm actually speaking to you today from Raleigh, North Carolina, which is a perfect example of where there is really a dearth of housing to meet the demand curve at this point. And again, that's another opportunity, I think, in a reasonable way for banks and financial institutions to probably solve this negative loan growth issue. Small colleges and universities are one, they've been double whammied by both COVID and the fact that there has been a significant runoff of charitable giving, perhaps unwittingly because of the Tax Reform Act of 2017, which basically de-incentivized charitable giving by doubling the standard deduction. Barron's projects as much as $68 billion less in charitable contributions were made in tax year 2018. Restaurants and hospitality, we certainly know, are clearly issues in every one of our markets. I have to give one of our client bank CEOs, Kevin Fahrenkopf, credit for this term. He says in his pipeline meetings every week, he asks his team, is the prospect Amazonable? In other words, can it be obtained on the internet or the service or the product? Because if it can, then that certainly is another headwind for our traditional bank customers. I would argue also that in the end, though, one of the biggest things I have realized over the years is that because I get asked this question a lot from people, what is the biggest single factor affecting credit quality in our portfolios? I would argue it's how does the marketplace value the commodity? And that's a broad definition of the term commodity, but how does the marketplace value products, goods, and services produced by our borrowers or prospects? Because it really does determine supply and demand. It has impact on revenue margins, repayment capacity, and yes, even collateral value. So let's talk a little bit about kind of what I call the trifecta of loan quality that's going on in the nation as of the second quarter call report. Again, this is public information from call report information. It does show from in most of the cases, the regions are a little below the national average in terms of NPLs. NPLs or non-performing loans is the inventory. Net charge-offs, non-existent virtually all across the country at this particular point in time. And generally speaking, the prototypical ALLL to loans, these again are banks in the less than $10 billion in asset categories. We're in the sense at about the 150 nationally, or excuse me, about 142, 150 basis points nationally on reserves to loans. An inverse of that would be that in all regions, we're covering our acknowledged problems, as benign as they seem to be at this time, at least 2.5 to 1. And ladies and gentlemen, that does not even include capital. So we've got a cushion there. And I know this is a little bit heresy coming from a credit guy, but if you look at these numbers, what you're basically seeing is, and if you add capital on top of that, then you being the industry, financial industry, has got potentially some wiggle room around taking a little more risk to try to overcome this negative loan growth circumstance that we're going into. But there again, I think it behooves the need for a much more robust loan review if we indeed do take more risk. So I don't believe that anybody, and I speak to bankers virtually every day and financial experts and credit experts every day, and I don't believe anyone believes that the current credit metrics will last, particularly when government stimulus ends, as it will indeed, and that the post-regulatory respite of 2020 is over. Every sign we're hearing is that regulators, or as they say, are back in the saddle and are expecting fairly robust information from financial institutions about where their current risk profile is, particularly in a post-COVID environment. We do believe very strongly that early detection of emerging credit risk is critically important in reducing losses, as well as, frankly, providing you with more latitude to move credit side. And that is a fundamental benefit, we think, of good, effective loan review. And I do think, as I alluded to a moment ago, as boardrooms and C-suites start, frankly, wringing hands over where are we going to get more loan growth in the next year or so, there's going to be pressure to become more aggressive, perhaps cut corners on heretofore credit standards and risk appetites. And we also know that behooves us to be much more vigilant, because empirically proven is that vintages of loans that are created in environments like that tend to become more problematic when credit stress rears its head. Again, I say this again, what is critically important, particularly in a post-COVID environment, is not to be seen as kind of the deer in the headlights, but make sure you are able to write your own financial institution's credit risk profile before any regulator writes it for you. So let's talk a little bit about some best practices. I do believe that it's important that you have reviewers with deep credit experience, not just junior CPAs. People with CPAs certainly understand credit generally. The language of credit generally is accounting, but just being a CPA with no credit experience doesn't make you sometimes the best reviewer. I would ask or advise each of you to ask for bios of each of the reviewers that are being brought into your institution by third-party reviewers for that exact reason. I do think best practices also call for kind of a separate documentation and review, which means that maybe what you might think of as paralegal experts can comb through the documents for technical exceptions, conveyance of collateral, capacity to borrow, and such. The reason why that's so important is you'd want your credit reviewers or your credit-focused reviewers to be much more focused on capacity to repay and more traditional credit analysis issues. I think, again, using technology to have very smart and informed sampling is a best practice, as opposed to any form of just random selection, or even sometimes just the typical, let's do just the top down in terms of size. Make sure that you are focused on exceptions in 3 categories: documentation, again, the more technical questions or issues; credit exceptions, which again is financial, the capacity to repay; and then policy exceptions. Policy exceptions would be particularly, could be waived, of course, if it had been either mitigated in writing and or approved appropriately. Kind of get a feel of pre and cleared exceptions. Why this is important is to a bank management and to a board, is that you need to know how much of your credit process is working accurately in terms of feeding information to the file appropriately and accurately, as opposed to just doing scurrying around to clear exceptions in the once the review is over. I do think underwriting needs to be assessed by your loan review, and also post-booking servicing, and they're 2 distinctly different disciplines. Your loan review ought to be looking at pricing for risk collateral valuations, again, in loan vintages, segregating your portfolio in ways that you're getting some good, valuable information around what are the risk profiles that may emanate from those particular three areas. You could do some companioning sensitivity stress tests. There's a lot of indication that regulators are now expecting community financial institutions to start stress testing, even though there's no prescription following the Dodd-Frank Act of 2011 or 12. We didn't have any requirements for community financial institutions to do stress tests. But the good news there, it's in somewhat the eye of the beholder, because nobody probably on this call is a DFAST or certainly a CCAR lender. So again, we're big advocates of companioning a little sensitivity or a stress test, if you will, as a subset of the loan review sampling. Utilize technology to make a more transparent and less intrusive process for your loan review. I think it's very important that you make sure that your loan review group uses your standards, your definitions for the pass grade definitions, not just their intuitive sense of what a risk grade 4 or risk grade 5 should be. Obviously, the national averages, the national standards are pretty well set in terms of the criticized classified categories by the regulators. But the past definitions, frankly, are idiosyncratic to your institution. One of the things that has changed from the interagency guidance released in May of 2020 is now the requirement, frankly, or the strong suggestion by regulators that workout plans or materially large criticized or substandard loans or worse be reviewed independently. Heretofore, that was often a credit that was taken off the table over the presumption we don't need to pay a third party to review something that we already know the problems about. But the regulators have come up with the sense that even workout plans or any kind of materially impactful problem credit needs to have some independence associated with that. We're certainly incorporating that into our sampling process in adherence to the new guidance. I do think that it is important that you get comprehensive both board reports and management reporting that's not just superficial and not just limited to individual write-ups of credits that were reviewed. In the end, I think, however, and this goes to our first polling question, is your loan review process should be highly collaborative and consultative, because it is an advisory process. It's not just another audit experience. So I do think that's critically important and a best practice for loan review going forward. But again, technology is about everything we talk about today in the financial industry. Is how do we embrace technology safely and appropriately and efficiently? And I do think there's all sorts of reasons why we need to go there, because it does reduce a lot of the intrusiveness on particularly your day-to-day involvement of managing credit. And technology can play a huge role in that. The efficiencies that are realized by the review team are also clearly realized by the team at the financial institution as well. Specific examples of what I think ought to be coming out of loan review are some recognition of clearly concentrations by band. If there's any kind of the chart to the upper right, or excuse me, upper left is obviously coming from public data. However, more idiosyncratic non-public data would inform things like pricing for risk. So in other words, is there illogic associated with some of the pricing that's going on? For example, a low pass risk grade is actually accruing at a level lower in aggregate than the risk grade a mid pass, which again is illogical, and it kind of implies that you're not getting paid perhaps for the risk you're taking. Understanding your concentrations. Obviously, risk-based capital is critically important in the banking world, and whichever lever you're using, community bank leverage ratio or the other, it's important because, there's a client we had in the state of Nebraska that was 650 of risk-based capital tied up in ag loans, which of course is understandable where that particular institution was. But they were able to basically disabuse the regulator immediately over the pristine nature of that portfolio by showing information, because there's always going to be a proxy by the regulator as to what's going on at your bank when they begin a process, or your institution when they begin a regulatory examination. Frankly, it is up to you to disabuse them if that is an incorrect perception. And again, loan review and the things that come out of loan review should be a key part of what you are able to build your so-called credit script about and around. One of the things that I think is going to be very vexing in kind of the post-COVID world are the need to subset our portfolios. We have a tendency, I think, to feel comfortable in aggregate about what's going on. Obviously, the numbers show of highly benign, more aggregate performance in credit risk. But again, COVID has left us with a whole swath of subsets and sub-industries that are in more stress than others. And I think it's critically important that you be able to slice and dice and subdivide your portfolio into areas. A perfect depiction of that would be in this category, and that is how do you look at the traditional bell curve of risk grade migration on the left? That's a portfolio as at large. And a subset of that is in residential construction for this fictitious bank. It would be where the bell curve has shifted to the right, implying, yes, it's still in average pass grade category, but it's showing, in theory at least, heightened risk. That would be an example of how you would perhaps take a little more dive in your loan review in areas of subsets that may be showing a little higher risk. And I mentioned smarter sampling is the ability to take your portfolio and look at it from a standpoint of what are the hotspots, if you will, where looming risk may be emerging. Again, remember, the art of credit risk management is largely around early detection. It is never about waiting until it becomes criticized or classified or public call report data cannon fodder, because as they say, those horses are out of the barn if you wait that long. But again, the ability to identify a subset, make that a part of loan review. Please understand there's nothing wrong with looking for heightened risk in a loan review. There are some people that tend to just instinctively say, well, your sample is stacked for risk. Well, again, part of the issue is to give you the ability to perceive emerging risk, and that shouldn't be seen as just a need to further sugarcoat something that may be embedded in your portfolio, but for whatever reason you chose not to identify. Again, the ability to change or to clear reporting in real time is certainly something we embrace, and I do think that's important to utilize that as much as possible in terms of modern technology. Again, the new guidance came out in May of 2020, and the real headliner, as we alluded to a moment ago, was the need to look at acknowledged problem credits. I think regulatory expectations are clearly changing. We are absolutely getting feedback in an anecdotal way to indicate regulators back in a more normalized examination process now are putting significant expectations on financial institutions. I was in a state, speaking at a state group, trade group, just last week, where one banker shared that they had given 5 extensions to one particular credit, and they made, and it admitted in front of the group that we made probably a tactical error or strategic error of doing that, because the regulator immediately forced that loan into substandard. In other words, the point being, they felt like the free period of extensions and modifications has expired, and the onus now is on the financial institutions to be absolutely sure there is still financial life at the other end of that borrower who may have had legitimate reasons to have extensions or modifications during the worst part of the COVID in 2020. Again, I think they are expecting you to take very robust steps to explain how you're doing, what you're doing with COVID, and how is that affecting your portfolio. So let's do pivot now to polling question number 2, if you wouldn't mind participating. Hopefully you're seeing that polling question. Hold on, I need to get the question there, and I will launch this and give you a few seconds to respond. Does your loan review tie into portfolio analytics, stress testing, or both, or neither? All right, we will close the poll. Let me share results. And this is an interesting result, which I think is healthy. I think certainly to have loan review tying into both stress testing and portfolio analytics, I think is very very positive, because I think strategically that is important in the industry. So the reason I think that's important is I do sense that in some cases, stress testing, loan review, and portfolio analytics are often performed by different vendors during different points in time, using different methodologies. And frankly, it provides management and boards with rather diverse or diffused credit risk information points. And while it may indeed be a checklist, we think certainly that best practice is to find a way to put those in sync in a little more standardized way. In other words, just depicting this more sense of, they're all 3 different disciplines. We know that, but the more they inform each other, the more they have relevance to one another in terms of their finding, I think is really the more optimal way to strategize around that. So how does this make loan review better? I think, again, one, it does make loan review better with smarter sampling, particularly it's tied to portfolio analytics. And I think stress testing companioned with loan review is a good way to kind of work that into your repertoire, if you will, of risk management, particularly now that we know that regulators are putting a lot more emphasis on stress testing, even at community financial institutions. Why companion it with loan review? It really does, I think, kill 2 birds with 1 stone. The efficiency around the file-by-file engagement, I think, makes sense. One could argue that loan review, during the process of loan review, is arguably the most real-time perspective of a borrower's current circumstance, offsetting some of the risk relying potentially on out-of-date initial credit underwriting data or data that may be residing on your core that could well be robust, but not necessarily timely. And I do think it is another way to kind of verify or validate some of the sensitivity analyses that were performed perhaps at original underwriting. Again, combined, I think this would be an excellent way to combine robust loan review findings with some degree of stress testing incorporated in that, and it gives you, again, a much better overall sense of where you are, particularly with these huge amounts of uncertainties that still remain in our portfolios. Specific examples of that, of course, would be to take an inventory of what data points exist in your portfolios. Again, as we alluded to a moment ago, find subsets that may be giving you some concern in terms of hotspots. Create a standard by which you'd like to apply a sensitivity, and even the FDIC has suggested a few years back this would be a quite credible stress test for community financial institutions, where in this particular case only 2 factors were applied to a CRE portfolio, factors being debt service coverages and loan to value percentages, which were stressed, and then, as you see, the pre-stress and the post-stress effect on risk-based capital. And this, of course, would effectively be a bottom up or a loan level. I'm a big advocate of doing both portfolio level, which is more public data informed, versus loan level, which is again the idiosyncratic mining of non-public loan data that's unique to your financial institution. So polling question number 3. Let's go to that, and that is your loan review primarily conducted by an internal group, an external vendor, or a hybrid of both? Get the polling question up and launch it for you. Hopefully you can see that. We'll give you a few seconds to respond to that. Great. I'm going to end the poll, and then I'm going to share the results, which is really it's very, very interesting, because it's kind of a even split between an internal group and an external vendor. That's a very interesting, but I am seeing that 30, let's see, 8 of you, I guess, on the poll says a hybrid of both. I think that's very, very interesting, because we're seeing an emergence of that, where financial institutions are comfortable with some form of an internal group. For example, they may be doing their mortgage purpose loans or their consumer purpose loans internally, but outsource their commercial purpose loans to a third party. So that's an interesting dynamic there. Again, one of the things we like to think about, that this is kind of pivoting over to our philosophy about how we do loan review. This kind of spaghetti chart depicts arguably what I think traditional loan review has been. Any way you cut it, it's another form of like an audit, or external people kicking the tires, intruding on your time and creating interruptions and so forth. We at IntelliCredit have been dedicated to building a process that is much more efficient and much less intrusive. But at the same time, as I've alluded to before, certainly done by very skilled and deeply qualified credit experts. So don't ever let the presumption that high technology, or fintech, if you will, is a justification for superficiality in terms of assessing credit risk during the loan review process. So in conclusion, this is an IntelliCredit webinar, and I've tried to share with you, for the most part, common best practices. But I do feel like at this point, I'd like to just close by saying, for all the work we've done in the last 2 years since we were founded, is we've spent a lot of effort and time to try to put the optimal loan review experience together. Having been through so many thousands of it myself, having understood the burden it places on financial institutions, and utilize technology. One of the benefits that it does, I think it lowers the, frankly, cost of it due to the technology. That's what productivity is. It's a levering of technology. And I do believe, as one of our satisfied chief credit officers said, I get to do my day job and still get first-class deliverable. Point being is the distractions are reduced because of the use of technology and kind of real-time environment. One of the things that we're the proudest of, frankly, is that the industry is endorsing this. Even nominal competitors, people like ProBank Austin, Warren Averett, a large accounting firm in the Southeast, they do their own loan review, and they have embraced this process in terms of its efficiency and effectiveness for their book of business. We do feel like, for obvious reasons, that the best practices I walked us through in the early part of the webinar, we certainly adhere to. That's part of our culture. That's embedded in every step of the process we use to deliver loan review. We certainly do adhere to and assure you that every aspect of the strengthened guidance that was released in May of last year is embedded in the IntelliCredit approach. So what are next steps? We would certainly appreciate at least an RFP for your 2022 loan review. I know in this era, there's a lot of need to look at maybe even rotating, but certainly from a corporate governance standpoint, to solicit other bids. We're very, very comfortable that we can meet or beat the cost of your loan review because of all the efficiencies that I've kind of alluded to. And again, what we would love to do is have an individual discussion with you that you're certainly willing to talk to us. We would be glad to do it. In a nutshell, what we are is a platform that does allow for services for loan review as a traditional service, but it's also on a cloud-based application for use internally as a hybrid. And if you do use us for third-party service, you get the benefit of all that technology. It's cloud-based, it's SOC compliant, and certainly we would provide you with all the full array of vendor due diligence to that. Again, I really appreciate the opportunity to speak with you today about best practices in loan review. If indeed you're looking for alternative solutions for next year or for your next loan review, we would love to talk with you. I've put my own cell number here. Please reach out to me by email or cell phone, and we'd be glad to schedule a telephone or even a mini demo of what the process looks like from IntelliCredit. And again, we feel very, very comfortable that we would be very competitive from a fee standpoint. Again, remember, that's our QwickRate culture of being part of a family of offerings that provide products and services to the community financial institutions. And that is the heart and soul of what we are all about. So again, we thank you very, very much. And let me see if there are any chats. There does appear to be. Okay, that one question here is, we have observed an appropriate expectation for the amount of portfolio coverage that a bank would achieve their loan review each year's percentage. What is? I'm sorry, what is? Yeah, that in good times has traditionally been somewhere in the 20 to 30% range. I have heard that some of that's been upped to about the 35 to 40% range, largely because not of emerging credit problems, but again, because of all this uncertainty, Robin. And that's again anecdotal, but typically what we are seeing traditionally in a non due diligence environment, or where there's an M&A situation going on, that usually 20 to 30% suffices. Yes, we are going to send out the PowerPoint presentation. Glad to do that. And again, if there's any other aspect of business material or collateral you'd like to get from us, we would gladly do that. And even if you have a call about just a generic issue that may not necessarily lead to us performing anything, I would gladly like to talk with you. I do a lot of speaking to trade groups in generic ways, and the drill. That's not a sales pitch. It's just really to talk about credit is my passion. And I do think, we live in very uncertain times. We're not through the COVID thing yet. And I think most financial experts and risk managers do know that intuitively, even though as I said, we've gotten through a lot of the worst part of it in much better shape than we thought we would. And any other questions you may have, feel free to email me. Again, it's been a clear pleasure to be with you today. I hope this has been helpful to you as you be thinking about your risk management plans and activities leading into the future. So best of luck to you. And again, thank you so much for attending.